next guest continues to be favorable towards AI, but has some concerns the back half of the year. Let's welcome in Dryden Pence. He is the CIO for Pence Capital Management. Dryden, good to see you.
Good to see
on
you.
Set.
Happy to be here.
So here, obviously one theme we've been talking about a lot, Dryden, is how, yes, the rally has been narrow. Investors have been sort of hyper-focused on this, trying to make sense of it. You say, though, Dryden, leadership might change in the back half of the year. So you see possibly maybe the baton getting handed off. Why do you think that, Dryden? And who does the baton get handed to?
Well, I think the baton gets handed to a wide array of companies, but the reason why we see this in the back half of the year, you've had this long period of time where you had a lot of the S&P inside an earnings recession, but kind of rolling recessions turn into rolling recoveries. And as we get into this back half of the year, I think you're going to begin to see earnings pick up in the 493, the broadening out of the rally. And I think one of the key reasons for that is you now have had a year of 5.5% interest rates. So corporate CFOs understand their cost of capital. They can plan better. I mean,
they've been preparing.
They've been preparing, and that's going to finally show up in additional earnings because you know your cost of capital. You can predict your margins. You're going to see some margin expansion, and these companies that the basic guys out there are going to begin to get back on track. And I think we're going to see this margin expansion in the second half of the year. The 493 is going to broaden out, and I think that's what propels the company. We love AI. We think all the parts of the chip supply chain are good, but when you think of leadership, they can only lead so far. And so at this point, you think the rest of the market broadens out and moves forward as we're going to see, I think, a lot of earnings surprises in the rest of the 493.
So it's not that those leaders are necessarily going to come down. It's more that everything else is going to rise. Maybe not to meet it because the growth has been pretty spectacular, but at least in that direction.
Right, because when you think about the S&P around 22% price per share, and then but if you take a look at everything else, they're down about 17s and 18s. So there's some room for the rest of the 493 just to catch up, and they don't even have to catch all the way up.
Right.
But if you just get you move from 18 to 21 on PE ratios, well, that's a pretty strong move for the rest of those companies. So I think the leadership changes because it broadens out. You got a lot more horses in the race now.
And Dryden, we did get some Fed speak today. Look at your thoughts on that. We had Governor Michelle Bowman speaking, said she sees upside risks the inflation outlook. We heard from Governor Lisa Cook, said it would be appropriate to reduce rates at some point, thinks inflation improves gradually this year. Any of that language surprise you, Dryden? What are your expectations for the Fed this year?
Our expectation for the Fed is you may get one at the very end of the year. We've been in the camp that we're going to be higher for longer for a while. And you're going to continue. At some point they pivot, but
they'd like to pivot.
They'd like to pivot, but I think it continues to move to the right because you have this tremendous robustness of the American economy. I think what people have forgotten is we've added so many workers. We've added 6.1 million new people working in this country since the height of pre-pandemic. When you think about that, that's like adding the entire labor force of Illinois. And that's like adding the entire GDP of France, which is the 7th largest country in the world. And so we've grown France in the last 4 years. That's a lot of money in the economy. And so I think that continues to give a strong base, and that's one reason why they're having a little hard time with getting inflation. If you give American money, right, what do? They spend it, right? And that kind of drives aggregate demand, and I think that that's one of the key things that are happening here. So I think we just continue to shift right. Sooner or later they pivot a quarter of a point, and then they're going to kind of wait and see. But I think you can only get the inflation genie back in the bottle so many times, right? The last thing they want to do is have it reignite. So I think
cut and then have to take it back.
Yeah, have to take it back. So I think they're going to prolong this out. But since 1971, we've lived over half our lives with a Fed funds rate over 4%. It's not the end of the world, and so I think that we can kind of survive this for a while and continue to have a very robust economy.
Yeah, as people get used to it, I guess. I want to pause this conversation because we just got some numbers coming out from FedEx, and in particular, the forecast is getting some attention here. The company's fiscal 2025 adjusted earnings per share, it is predicting will be at $20 to $22 a share. 21, right in the midpoint there, is above the 2085 that analysts had been anticipating. You can see revenue coming in line with estimates and adjusted earnings per share at 541, a little bit ahead of what analysts had been anticipating. The company also says for fiscal 2025, it is expecting a buyback of of up to $2.5 billion worth of its shares. So that also supportive of the shares, and they are seeing a 9% gain here in just as we see the first blush reaction to those numbers. Also, we got the statement here from the company as well, Josh. What stands out to you?
Well, yeah, I mean, it's interesting why you kind of look at FedEx even more broadly. You know, obviously we look at it as a kind of economic bellwether. You know, people look at this as sort of a read on the consumer, where they're at, and kind of where they're headed. I think guidance is a big focus. I think also that the cost-cutting efforts, Julian, obviously FedEx has been working to get leaner and meaner. The stock had not done a whole lot heading into the print. I mean, it was basically flat and up single digits over the past 12 months, but at least initially, nice pop here in the after hours.
Yeah, and I wanted to wanted to focus on some comments also that Raj Subramanian made. He is the CEO of FedEx. He talked about making significant progress in fiscal 2024. This is their last quarter of their fiscal year, and 4 consecutive quarters of expanding operating income and margin that he is highlighting in a challenging revenue environment. And he also talked about the efforts to try to transform the company here, and he says momentum is going to continue in fiscal 2025. Remember, FedEx has experienced some setbacks, including losing the USPS contract to UPS. That was something that happened in the past year. So this looks like a bit of a relief for investors.
Yeah, up almost 10% here in the after hours. Dryden, any views, takes on FedEx here, or transports more broadly?
Well, we like FedEx, and it exists in some of our unit investment trusts. And I think what you're seeing is 2 or 3 things going on here. First, this is, again, that broadening out thing we just talked about, because you're beginning to see that earnings recession.
The thesis playing out in real time, Dryden.
It's playing out real time, which is a good thing. But I also think you're seeing a re-acceleration of e-commerce, and I think that's going to help FedEx all the way through. As e-commerce kind of peaked in COVID and then kind of came back down, and now we're seeing a re-acceleration in the growth of that. That's going to be I think accretive to FedEx. I like stock buybacks. When a CFO thinks his company's worth a lot more than everybody else does, he knows more about the company than anybody else. So I think that all of those things are positive trends that we can see. And I think that you're, again, cost cutting, getting that whole margin expansion thing we're talking about. So I think that this falls into that, and that's a favorable thing for us.
How long, FedEx talking about continuing to try to get costs in order, get new discipline here, not just for FedEx, but more broadly for companies. Where do you think we are in that cycle? Or do you think that cost discipline is here to stay for a while? I think
cost is, back when we had peaking inflation, whether you needed to raise your prices or not, you did. You had a wonderful excuse, right? So everybody was able to raise their prices, but then they needed to come in behind that and actually impose some discipline. And so I think cost cutting is now going to get very important to people. They've raised their prices almost as much as they can. You're seeing some consumer pushback on that. So now if you want to expand your margins, you've got to have some discipline. You now know what your cost of capital is. The next move there is down. Now let's get our operations straight, and let's try to figure. So I think FedEx is recognizing that and playing right into that. So going through this quarter, next quarter, and next quarter, I think they're headed in the right direction. But I think you're going to see more and more companies coming out and say we're going to impose some discipline here.
And I mentioned, Dryden, I mean, people, folks still do look to FedEx as a kind of bellwether, kind of the macro, the consumer. Do you use it for that as well? Do you think it gives you a broader read?
It does. It does. And FedEx is almost a verb. I mean, that you say I'm going to FedEx it to you, even though you may use a different carrier. And so I think you want to be a verb as a business, right? You're so ubiquitous out there. But I think that I do think it is a bellwether, because particularly on the e-commerce side, now you have to look at Amazon, you have to look at FedEx, you look at UPS and all of these things. But e-commerce continues to grow dramatically as a part of our national pastime, which is retail therapy. And so I think that that FedEx is going to be a great benefactor of that, but it's also a great read when you just look at volume of package.
Yeah, I just want to mention a couple more details from the statement, kind of to the themes that we're talking about in terms of cost cutting. The company is permanently retiring 22 of its Boeing 757-200 aircraft and 7 related engines. It says it's continuing to modernize the fleet, but obviously that also can help cut some costs. The other thing that stood out to me is international yields did not perform well, but that U.S. domestic package yields did perform better, which kind of speaks to what you're saying here, Dryden, about maybe a little bit of pickup here in U.S. demand.
Exactly. I mean, the U.S. economy is moving at a little bit different speed than the rest of the world, and so we're kind of picking up a little faster, a little stronger, more robust. I talked about all of the people working. We've grown France, right? So I think that in that sense, all of this feeds through to a continued greater aggregate demand. And that means the consumer is going to shop more. And if they're shopping more, they're shopping online. And if you shop it online, it's got to get to your door. And I think all of those things feed right into this. And fuel prices are a big deal. So if you can retire your inefficient fleet for a more efficient fleet, that's probably going to help that cost-cutting thing we talked about.
Right. Yeah, definitely. All right, Dryden, thanks so much. Appreciate it.
Absolutely.
Nice to
Thank you
see
for
you in
having me.
person.